If you're between 36 and 55, this video is for you. You're balancing career, kids, aging parents, maybe a mortgage, and you're wondering, am I investing smart enough to protect our future? Take a breath. Tonight, we're cutting through the noise. No hype, no day trading drama, just a calm, practical roadmap to building a portfolio that quietly works for you. Over the past century, diversified stock portfolios have returned around 7–10% annually before inflation. Not every year, some years hurt. But over time, discipline has beaten panic. In the next few minutes, I'll show you how to turn your savings into a structured plan, what to own, how much risk to take, and how to stay steady when headlines scream. Think of this as financial muscle building, slow, steady, sustainable. Let's start with the real purpose of your portfolio. Your portfolio is not a scoreboard, it's a tool. In the last shot, we framed investing as financial muscle building. Now let's define what that strength is for. For many of you, it's 3 pillars. Retiring with dignity, helping your kids without sacrificing yourself, and protecting your lifestyle from inflation. Historically, inflation averages about 2–3% a year. That means cash alone quietly loses power. A well-built portfolio aims to grow faster than inflation while smoothing the bumps enough that you can sleep at night. Start by turning vague wishes into numbers. I want options at 60. I never want debt to control us. I want a safety buffer. Once your goals are clear, investment choices become less emotional and more intentional. In the next segment, we'll zoom out from your kitchen table to the actual behavior of the stock market you're trusting with those goals. With your goals in mind, let's look at the world you're investing in. The stock market doesn't move in a straight line. It moves like a heartbeat, jagged day-to-day, but with a long-term rhythm upward. Visualize the last 50 years. Oil shocks, dot-com bust, 2008 crisis, pandemic. Yet broad U.S. and global stock indexes, dividends included, have still delivered around 7–10% average annual returns over the long run. The catch: you only earn those returns if you stay invested through the noise. For a 45-year-old, that's crucial. You may have 25 years until retirement, plus decades after. Your timeline is longer than most headlines. So instead of asking, what will happen this quarter? Ask, what mix of investments lets me ride out storms without bailing? That question leads us to the quiet superpower of smart investors. Diversification. That question, how to ride out storms, brings us to diversification. In the last shot, you saw the market's heartbeat, volatile but rising. Diversification is like not relying on a single paycheck to run your household. If one income drops, others keep the lights on. Practically, it means owning many companies across sectors and countries, plus steadier assets like bonds. For example, in years when stocks fall sharply, high-quality bonds often hold or rise, softening the blow. A simple diversified mix, broad stock index funds plus bond funds, has historically reduced big losses while still capturing most long-term growth. You don't need to guess the next winning stock or timing every cycle. Instead, you build a basket that's resilient by design. Next, we'll break down those building blocks, stocks, bonds, and cash, so you can see exactly what role each plays in your plan. We've seen why mixing assets matters. Now let's simplify the core ingredients. Think of your portfolio like your household budget. Some money goes to growth, some to stability, some stays instantly available. Stocks are your growth engine, ownership in businesses. Over 20+ years, broad stock markets have often outpaced inflation significantly, but with sharper ups and downs. Bonds are your stabilizers, loans to governments or companies. They usually offer lower returns than stocks, but with less volatility, cushioning your portfolio during stock market drops. Cash is your emergency brake, low return, but instant access and psychological comfort. For many 36–55-year-olds, a mix of these three, access through low-cost index funds or ETFs, is more effective than chasing complex products. In our next segment, we'll talk about risk and volatility, how to decide how much of each ingredient you can realistically live with without panicking. Now that you know the ingredients, let's talk about how much spice you can handle. Risk is not just numbers, it's how you feel when your portfolio drops 15% on paper. Between 2000 and 2020, investors saw multiple declines of 20% or more. Those who sold in fear often locked in losses. Those who stayed diversified and patient historically recovered. Your job is to choose an allocation where you can stay the course. A common starting point for someone in their 40s or early 50s might be 60–80% in stocks, 20–40% in bonds and cash, adjusted for your job stability, savings rate, and personality. If a hypothetical 25% drop keeps you up at night, you likely need more bonds. In the next shot, we'll convert this into age-based asset allocation guidelines you can adapt, not blindly follow. We ended on a key idea: your allocation should let you sleep. Age can help guide that decision. Think of risk like how far you are from the edge of a diving board. In your late 30s to mid-40s, you still have time. Many investors choose something like 70–80% stocks, 20–30% bonds, and cash. In your early to mid-50s, you may dial that down to 65% stocks, increasing bonds for more stability. These are not rigid rules, they're starting frameworks. What matters is matching your mix to your horizon, emergency savings, and resilience. Remember, being too conservative too early can also be risky. Your money must outpace inflation for 20–30 years of retirement. Next, we'll pair this with a simple technique, dollar cost averaging, to help you invest consistently without trying to guess the perfect moment. You've chosen a mix that fits your age and nerves. Now, how do you actually put money to work without obsessing over headlines? Dollar cost averaging. Instead of waiting for the perfect dip, you invest a fixed amount on a regular schedule every paycheck, every month. When prices are high, your dollars buy fewer shares. When prices are low, you quietly buy more. Over time, this smooths your entry price and reduces the stress of timing. Historically, staying consistently invested has often beaten those who sit in cash waiting for certainty. For a 40-something balancing tuition, rent, and retirement, this approach is like automatic bill pay for your future. Simple, disciplined, and unemotional. In our next shot, we'll confront the real enemy of smart portfolios, not volatility itself, but emotional reactions that turn paper swings into permanent losses. Automatic investing helps, but there's one more challenge: your emotions. In the last shot, we focused on consistency. Now, let's address panic. During sharp drops, financial news amplifies fear. Yet historically, many of the market's best days cluster near its worst. Investors who panic sell after a crash often miss the rebound. For example, missing just a small handful of strong recovery days over a decade can dramatically cut your returns. The solution is not to ignore risk, but to pre-commit. If my portfolio drops 20%, I rebalance, I don't run. A diversified mix, an emergency fund, and a written plan turn fear into manageable discomfort. In the next segment, we'll bring everything together with a sample balanced portfolio, so you can visualize how these principles look in real numbers, not just theory. You've seen the mindset, now let's make it tangible. Imagine you're 45, aiming to retire around 65. A calm, growth-focused, diversified portfolio might look like this: 50% in a broad U.S. stock index fund, 20% in an international stock index fund, 25% in high-quality bond funds, and 5% in cash. Historically, a mix like this has captured a large share of stock market growth while cutting the deepest declines compared to all stock portfolios. You automate contributions monthly, rebalance once or twice a year, and adjust gradually, maybe adding more bonds as you approach retirement. No picking individual stocks at midnight, no chasing hot tips, just a clear, rules-based system that serves your goals. In our next shot, I'll crystallize this journey into a simple checklist, your personal playbook for smart, steady investing from today forward. Let's turn that sample portfolio into your clear decision point, a simple checklist to guide action. 1. Define your goals in writing. Age: you'd like work to be optional. Key expenses: your must-have safety buffer. 2. Build a 3–6 month emergency fund in cash. 3. Choose your target allocation: how much in stocks, bonds, cash, based on your age and true risk comfort. 4. Use low-cost index funds or ETFs to get broad diversification globally. 5. Automate contributions every month, dollar cost averaging. 6. Rebalance once or twice a year to your target mix. 7. Commit in advance, not to panic sell. Review your plan, not the headlines. This is your Climax, a calm, evidence-based framework you control. In the final shot, I'll show you how to take the very first step tonight in less than 20 minutes without overwhelm. You now have context, structure, and a checklist. Let's make it real and simple. Tonight, give yourself 20 focused minutes. Step 1. Log into your retirement or brokerage account. Step 2. Write down your target mix, perhaps 60–70% in broad stock index funds, 25–35% in bond funds, a small slice in cash. Step 3. Select low-cost, diversified funds that match those buckets. Step 4. Turn on automatic monthly contributions even if it's modest. Then, close the tabs. Go back to your life knowing you've upgraded your family's financial trajectory. You're not chasing luck, you're running a plan grounded in decades of market history and your real-world priorities. If this brought you clarity and calm, subscribe to Smart Investing, share this with someone who needs confidence, and join us for deeper dives into building long-term wealth, quietly, intelligently, and on your terms.